So what is up YouTube? In today's video, I'm going to be going over two things. First is the GameStop short squeeze and what's going on with the stock and what I might do. And second is about another popular company that's trading at penny stock valuation, which I think can be a good short and long-term play. So first let's talk about GameStop. So GameStop's huge rally as of recent isn't because of a huge change in fundamentals. GameStop stock was extremely shorted as its short float was about 144%. And so this was one of the most shorted stocks in the world, and basically what happened is it was pulling the stock down and wasn't allowing it for much movement. And suddenly there was a change in management where the Chewy CEO became a member of GameStop, and then a group called Wall Street Bets started buying GameStop extremely heavily. So once they started buying heavily, the stock rallied a lot. And from there, what happened is the short sellers actually had to cover their position, which means they had to buy the stock at an expensive price because brokerages forced them to, which pushed the stock even higher. And recently, even more shorters entered, so this could just be the beginning of a short squeeze. No one really knows what's going to happen because it is basically retail investors in Wall Street Bets versus institutions like Citron. So right now, GameStop stock is really just a war between retail investors and institutions that short stock. And with this rally, GameStop short sellers lost so much money. They lost $5 billion, and I wouldn't be surprised if they lost even more because it seems like no matter what, the people from Wall Street Bets will just continue to buy GameStop stock and push the stock higher, and the shorters in GameStop will just continue to short it. And so the movements in the stock price with no real change in fundamentals is getting kind of dangerous because at this point people are buying out of emotion, and because GameStop was a microcap stock and it was valued at under $1 billion, and because it is such a well-known brand, it made sense for people to buy it. However, the rally with GameStop stock going on right now, the one where it's going to push GameStop above 200, is really just retail investors retaliating against institutions like Citron Research. Now, there are many reasons for this, but I think one of the major reasons is because institutions really control the stock market. If Citron Research says one stock is bad and they start shorting it, you always see the stock going down a ton. So maybe that just angered them. The lesson from this huge short squeeze in GameStop is to not short stocks because the maximum gain you'll get from a shorted stock is 100%, but the losses can be 1000+%. Usually brokerages force you to sell your short position before that, but you really never know. So now let's talk about what I'm doing with GameStop stock. So I actually bought 100 shares of GameStop stock on September 11, 2019, and I bought it for $4.46. And the reason I bought it is because it was like a well-known brand, and the reason the stock was so low is because of bankruptcy rumors, and I just thought it could be able to recover. Now what happened recently is not explainable. Like the huge rally, no one can explain it other than Wall Street Bets going all in on GameStop stock. So I'm actually going to slowly start selling my position because even though I think this stock will go even higher because I think the short squeeze just started, I don't think this will end well for anyone because I do think the SEC might get involved, and this is just it seems like a pump and dump to me. It seems like once it hits a certain valuation, everyone will start taking their profits and it'll just crash again. And as a long-term hold, the management is strong and it was a good company in the past, but there's just so much uncertainty with the valuation. It's already $10 billion, and plus there's going to be a lot of competition from various e-commerce companies, and so in the next 5-10 years it could be disrupted. I'm not saying it will, but there's a chance unless they change the business model as a whole. And I know a lot of you may have not bought the stock, so don't FOMO into it, and plus don't be disappointed that you missed out on it because this rally is completely unexplainable and no one expected it. So now I'm going to be talking about another well-known company that's trading under $1 billion that I think can be a great short and long-term hold. So the popular stock that I'm talking about is called AMC Entertainment Holdings and has a ticker symbol of AMC, and it's currently trading at $4.96 and has a market cap of $796 million. So this isn't going to be a full AMC stock analysis. I'll just be giving a few points. So you guys probably all know AMC. They do own theaters, and you guys have probably been to one of them. And this stock has been declining over the past few years because of fear that Netflix and these other streaming services might disrupt them, and because they haven't really been able to become fully profitable. And this well-known company has been dropped to penny stock status because of the coronavirus. People stopped going to their theaters and they weren't making any money, and they needed money to run their operation. And over the past few months, the AMC CEO has been saying that the company might go bankrupt unless they get $500 million in cash, and that many of its few lenders did want it to go bankrupt so they could probably recoup some of their money. However, they actually raised $900 million very recently. And so now bankruptcy is very unlikely with this new debt, and now I think even if COVID doesn't go over the next few months. I think once it does go, people will be eager to go back to theaters, and then they'll start making money, and there'll be expectations because analysts have no expectations for the stock. So with that, if they beat revenue expectations, then I think the stock will follow. And for those of you scared that Netflix or Disney Plus might force this company into bankruptcy, what you have to understand is people go to theaters for experiences, and streaming services have been around for a long time, and people who do go to theaters also own some like Netflix subscription or Disney Plus, so they like both, and I think they can both coexist. And some of these movies also want to go on the big screen before they hit streaming services. An example is Tenet. Even during a pandemic, before they went onto Netflix or another streaming service, they decided to go directly to theaters, and that is because they think their audience will enjoy the movie more on theaters. And I think it is important to hold recovery stocks, so like stocks, businesses that will recover if COVID goes, and one of these plays could be AMC. Right now I hold Walgreens Boost Alliance, Carnival Corporation, and I'm adding AMC to another recovery stock. And so I actually bought a very small position in AMC on January 25th at a cost basis of $4.49. And keep in mind, this is still a more speculative recovery stock, unlike Walgreens Alliance, because we still don't know how audiences will react to going to theaters right away. And they just took on tons of debt, so there definitely is risk to this stock. Now, with that being said, this was just a quick update video. I'll definitely make a more in-depth stock analysis on AMC very soon. And if you guys did enjoy the quick update, please do leave a like and subscribe. Also comment down below what videos you'd like to see, and thank you for watching.